this is just on a personal note. This last week was really interesting for me because, there's probably 3 people in my life that have sort of changed a direction for me. And this last week, one of those 3 people died. His name is Stephen Goodman. He was my professor, my top professor at the Graduate Theological Union. He was one of the guys that was teaching me how to read Tibetan. He was the guy who basically said, as I beat myself up because I couldn't stick with my meditation practice, to stop beating yourself up. Like you will waver until you no longer waver, was the message I got from him. He was just a wonderful guy, and I think today is a ceremony for him digitally. But I thought about him a lot over the years. He's one of those people that made a difference in my life, and I just want to recognize that he's not here. So with that, I'm gonna kind of go into a few comments. I'm gonna share. I have some slides I'm gonna share with some folks. Very, very mild slides, nothing too deep. We're getting a lot of questions about, can the market stay here? Can the market stay here? Can the market stay here relative to an economy that, seems to be pretty rough on the outset? But I'm gonna look at some data just really quick. I'm gonna go through a list of things that are going really well. And then there's actually a shorter list of things that are not going very well. And I want to have Scott, after I do that, Scott, chime in with some of those things you had mentioned earlier about what we see versus what is, and we'll talk about this for a second. So on the list of things that are actually going well, and we talk about this high frequency data, and part of this high frequency data, when you look at month over month or week over week, you might remember that 2 weeks ago and 4 weeks ago, there were some negative items. And the negative items were hotel occupancy. And what was happening was we had what looked like a surge in infections, and people slowed down in their hotel usage, and they slowed down in some of their flights, and which makes perfect sense, right? People got a little bit more nervous about the virus again, and so they slowed down. Today, and looking back over month or week over week, everything is positive. Everything in the high frequency data is a positive, except for one thing. And this is a new one thing. And the one thing that is a negative is the supply of gasoline in the United States. And if you think about that, if you go back, I don't know what it was, a month or 2 months ago, where oil went to below zero, a barrel of oil was more expensive to store than it was to buy. And so the price of a barrel of oil went below zero. And so we stopped, we shuttered a whole bunch of wells, and we stopped manufacturing, creating oil. We didn't have any place to store it. So we had this glut of oil. And now what we're seeing is, well, guess what? We're using some of it. And so now the glut is going down. And so we have a smaller store of oil by 1.7% month over month, 2.2% week over week. But all of the other high frequency data is positive. That includes things like the staffing index, weekly retail sales, box office receipts, flights, TSA checkpoints, open table, reservation data. It's all positive month over month and week over week. So some of those things that are the less high frequency data that are positive are light vehicle sales, mortgage forbearance. The numbers of mortgages that were in forbearance had reached about, I'm going to get this wrong, 5 million mortgages were in forbearance, and now it's more like 4.2 million mortgages are in forbearance. ISM manufacturing is positive. ISM non-manufacturing is positive. Factory orders are positive. Rail traffic is positive. Continuing jobless claims, kind of a positive and a negative. It's still very, very high, but it's declining over time, which is what we like to see. Corporate earnings, which we're going to talk about in a second as well, those have come in as an upside surprise. The 2 or 3 bad things that are out there, construction spending, it was weaker than expected. Private payrolls were weaker than expected. And, the simple fact that we're in this, we still have a virus that we're contending with is a negative. And I think that there is a lot of movement towards, we'll talk about this a little bit more in a second, a lot of movement towards vaccine. We definitely have better treatments than we did 6 months ago. There's a lot of movement towards vaccine. We haven't seen anything conclusive yet in that realm, so there's still nervousness about that. So there's a lot of positive data. There's still a little bit of negative data. The big overriding negative is still this idea that we're in the middle of a pandemic. And until we see an all clear from a vaccine or from the economic commentary from a pandemic, no one will feel safe. No one will feel good about it. And that's actually one of the things I want to talk about. And Scott, if you bring up the things you brought up earlier, I'm going to mute myself and let you go. You're muted, remember.
Yeah, I mean, Paul and I had a conversation with a client last week, and I don't think she was bringing to our attention something we haven't been hearing on a regular basis, which is, I just think Scott and Paul, when I look out there with the hotels and airlines and cruising and all these restaurants and that are struggling and retailers and department stores, how is it that the market is doing so well and yet these sectors are decimated and all these companies and employees and so on and so forth. And I think it's very relevant to today's conversation in that I don't think people realize the math, and the math is kind of interesting. And that is, so let's just use department stores as an example. So they may be down like 60, 70%. But I think the key here is if you look at the pie of the S&P, what slice of the S&P does that account for? And the answer is less than 1%. So although these sectors are in bad shape, they don't really account for the overall pie like they once did. And so their impact just isn't what it once was. Airlines, a little bit bigger, but not really, maybe 1 3/4 of the S&P. So there's not a real impact as far as that's concerned. And so I think that's really important. We don't want to say it doesn't really matter or, these sectors don't matter much because it sounds kind of crass and abrasive, but there's some validity to what I just said. And if you look at things like internet content, software infrastructure, consumer electronics, all the names that are actually working and all those sectors that are actually working, those account for 8 trillion of the $35 trillion that are out there in the marketplace. And so as an example, like the 10 biggest companies in the S&P, if you weight them equally, we'd be up 37% this year. If you just looked at that, you take the other 490 names in the index, we'd be down 7.7%. So the giants that are out there, they really do matter a whole lot more than some of these other sectors. And I think it's really critical. When you take the worst 50 sectors, and that's airlines and travel and hotel and motel and REITs and casinos, all those names that are suffering, that's only barely 6% of the S&P pie. That is why it feels like the world's coming to an end and the market isn't listening. The market actually, it looks like, is listening attentively and is paying attention to the sectors and the market caps of these companies and these spaces and these sectors of the market that matter the most. And it is market cap weighted. And I think that also, Jonathan, you could touch on that if you want to, but it speaks a lot. I mean, for airlines and these other sectors I'm talking about to literally be only 1%, that's why they're decimated and the Nasdaq's at all-time new highs. The S&P is bumping up on that, and maybe the Dow's down 5. A lot of those sectors they're just not as meaningful as they once were to the overall success of the market. Hope that makes sense.
Thanks, Scott. Yeah, I think I'm going to share my screen really quick and show you guys something that he was talking about here. Okay, share the screen. Here it is, share. So I think what Scott just said, and I don't know if this is big enough for people to see. Maybe I can embiggen it some. Here we go. So the idea is when you look at this, this is, the gray is the S&P, and for the year, it's up a couple percent. But we have to remember that the S&P is a cap weighted index. What that means is the really, really, really big companies in the S&P have an outsized effect on what the S&P, how the S&P behaves in terms of its price and growth or decline. And if you have these 5 companies, Facebook, Amazon, Apple, Microsoft, and Google, and they are doing really, really well because they can in a pandemic scenario, whereas Sears and Roebuck and JCPenney and Macy's, and they have a much harder go because people have to visit their stores to do anything. And they're very local. They're driven by a local economy, whereas Amazon is global and Google's global and Microsoft is global. So they've actually done really, really well. And there's such large portions of that S&P 500 that it looks like the S&P 500 has done really well, but there's 490 companies in the S&P that have not done that well. 495 when you look at this particular graph. And it's just good to keep that in mind when we're investing, because when you then multiply that, I'm going to stop sharing here. When you multiply that with an idea of how we invest, I'm going to share something else here. Okay. We talk about this idea of seeking value, and if you think about what we just said, with the S&P, there's 5 or 6 companies that have just really done incredibly well, and a whole bunch of other companies that have not. When you look at the last 10 years, we always talk about value. And we think value is important. We think the price you pay for a unit of book value or a unit of earnings is probably the most important piece of that equation. If someone's making a lot of money, but you're paying a lot for that earnings, then that maybe is not a good investment. If someone's making money and you're paying less for that, that's probably a better investment. And that's what this is saying. This is taken from, and this, I got this directly from a blog post, Verdad Cap, and this is taken from Ken French's data library. And Ken French is, Fama French is the duo that wrote the papers and have done all the research, original research that underlies all the kind of investment tools we use, which again, we focus on value, small companies, and profitability. And what we're seeing here in this top graph, the green versus the red, and you see how, in early 2020, the market, whatever you own, dipped. And then right after that, the red line shoots up. So what is that? These are things that are very, very public. They're those 5 companies. These are very expensive, not very profitable, but have done really, really, really well. Whereas these other companies, the cheapest and more profitable companies, are basically being ignored by the market. They're not going up the same way that Facebook and Amazon and Microsoft are going up. And that's where we're putting the bulk of the dollars when we're investing now. And so you can see, when the market recovered, you saw a huge recovery in those companies. And you've seen a little recovery in the other things, which means the market's not paying as much attention to the value of a dollar's of earnings as it's paying to like the media headline of how well the profitability of Facebook or Google or Microsoft. Now, the next thing we see on here is we see a 3 decades. So this goes back to 1992, 1993 to today, 27, I think it's 27 years. And this red line, it is the most expensive, least profitable companies. And it's outperforming right now, no question. But over the 30 years, it's the worst performing section, right? This section down here is the best performing section. Okay, now what if we hold that for a lifetime? In terms of, this is again, 1963 to 2020, this is the cheapest, most profitable versus the most expensive, least profitable. Now, there's gradations of this. You see there's cheap valuation all the way to expenses. There's 4 different levels split into quartiles. It doesn't matter if you get, going from most expensive, least profitable, maybe you continue buying the more expensive things, but you get to more profitability. That gives you a better return. Or you start with most expensive, least profitable, and you stay with low profit things, but you just buy them for a better price, better value, right? You get a better return. So the idea is if you mix a better price and higher profitability, you get a much better return. And that actually works out in the data. And the data tells us this, over that long period of time, high growth companies are going to do really well, but they're not consistent in any way. And you don't get as good a return, dollars or percentages, when you do it that way. So while there's elements of the market, those 5, 6, 10, I think Scott listed 10, really big companies that are really, really doing well in the market, in their price, That doesn't necessarily mean there are not investment opportunities. That doesn't necessarily mean we're chasing those things with the money we're investing. And it's really important to understand that we're not just diving after those things and chasing the hot dot or that big return. And that's with this kind of as a backdrop. One of the things I want to talk about is I think we did see a resurgence in the virus. We saw the number of viral cases go up and hit new records. And it looks like it's peaking. It looks like it's kind of tilting down from here. We don't know. We're not predicting what happens next. But most of those new cases, strangely, maybe not strangely, were younger, less vulnerable folks. So at the same time, we've developed better treatments. So the numbers of people who die from this are declining. We have better treatments. The people that are getting the disease now are less vulnerable. And kind of our generation's moonshot is this vaccine. This is the moonshot or the Manhattan Project, or it's the big scientific endeavor of the day. And we have the world's virologists and epidemiologists are working on this vaccine. I don't know when it's going to come. I don't know when we're going to have access to it. I don't know who's going to have access to it first. But in the meantime, we've had the kind of support, both fiscally and monetarily, that was fast. And right now we're in a pause mode. We're hoping to hear something this week about some extensions. They're not going to be as big as they were. We've had $3 trillion of support. Maybe we get $1 trillion, maybe we get $1.5 trillion more support. The markets are looking into 2021. And in March and April of this year, we actually couldn't tell. No one was predicting. All the analysts had withdrawn their estimates of what earnings might be in 2021. They had no idea at the time. Now they're actually starting to estimate again. And the average estimate looks like 2021 is going to look a lot like 2019, meaning write 2020 off. 2020 was always going to be a horrible year. Even if the third and fourth quarter saw a recovery, the earnings from the S&P was going to be down. They're going to be down enormously, and they will be down enormously. But the estimates for 2021 is actually for a return to 2019. Now, if you just allow for the same prices that exist today, those ones that existed at the close of 2019, maybe we don't have a lot of upside between now and then, unless we start thinking about, and it's only a matter of time before we do start thinking about, what are the earnings going to be in 2022? We're a year and a half into having a vaccine. Most things have returned to normal at that point. And when most things have returned to normal, there's no reason to think that Facebook and Google, as well as Sears and Macy's and Kmart's, and I guess Kmart's a bad example, all these companies that are actually selling their widgets and selling their services have higher profits than they had in 2019. And so it will make sense then for prices to have gone up from where they are today. You have to think ahead of where the economy is going to where the market might go, and that it's very, very likely that the long-term risk of holding cash is actually higher today than it was a year ago. The benefits of owning equities, given the kinds of returns we're seeing on cash, the kinds of returns we're seeing on 10-year treasuries or 30-year treasuries, it makes no sense to hold those things except as a ballast against the inevitable volatility. So we're looking forward to seeing better earnings, earnings returning to 2019 levels in 2021. It looks like our conversations about this 4 months ago are turning into reality, that's kind of what people are now projecting and thinking about. And so while there are trends and there are things that we can be concerned about, I think it looks like markets are actually doing what markets are supposed to do and pricing in the probability of better things ahead, not the fear that we're seeing that's local. Those big companies are doing really well. We're going to invest in those local things and those smaller things and continue to do so where there's value, where we can see profitability. So I realize that we didn't introduce this earlier with how do you ask a question? So I want to actually put that in there right now. please, if somebody has a question, pop it into the chat or raise your hand or unmute yourself, which you can do, and just ask a question. John, you usually give us a good idea of at least the local real estate market. You wanna do that again today?
Sure, I can do that. But first off, I just want to comment. There's that old, I don't know if it's a quote or if they talked about Wayne Gretzky, the hockey player. I don't skate to where the puck is. I go to where the puck is going to go. And so even if you're not a great skater or a great hockey player, that's one way of looking at the way you invest. And if you invest broadly and globally, the big picture, that's where we're going. And that's maybe what the market is seeing. And if you just focus in on, 4, 5, 6, 7 big companies, you might get checked into the boards, so to speak, because the bigger they are, the harder they can fall. But anyway, locally, the real estate market now, here we are in August. It's like the way the market traditionally is in February and March. And of course, the market completely slowed down due to the pandemic and not being able to show homes. Traditionally, all the agents around here, at least, are used to marketing now in accordance with the rules and regs that are out there, and things are busy, very, very busy right now in the residential real estate market, from Richmond all the way to Oakland and in between, Alameda, San Leandro, the whole thing, the whole corridor up here is really busy.
Thanks, John. Do you get any sense how that's different? I don't know if you hear words about how that's different from the national real estate environment.
I'm not really sure, but I think that areas, like Boston, well, I'll tell you one thing. In the and maybe Joan can speak of this, but in the the New York State area, I don't know what they call it, the tri-state, what's that? New York, Connecticut, whatever. There's a lot of activity in second homes. A lot of people are very interested in purchasing second homes. I've read that.
And I know it's really interesting because I do this every now and then. I decide, let's start looking at a second home ourselves up in Tahoe, and we started looking at it again, and every house in Tahoe is either pending or it's in contract, and I was completely blown away. And it's interesting. It brings in a conversation I had with a client because she said she's in HR, and she said that, Twitter and all these tech companies are saying, hey, we're actually going to make it optional for people to come into the office, in the future, like after there's a vaccine. We've discovered that, hey, this actually works. We can work remotely. This is fine. And we've always wondered, and now we know. And so we're going to make it optional. And so while they're making it optional, people are saying, okay, if I can keep my job, why would I live in the Bay Area where it's so dang expensive? Why don't I move to Tahoe? It's still pretty expensive, but less expensive than the Bay Area. Why not move to Ohio? Why not move to someplace where just the cost of living is so much lower? And the thing that she said was, eventually companies wisen up to that and say, well, if you're going to move to Ohio, you're going to have a lower cost of living. That's going to come with a lower compensation package. And so right now we're seeing the purchases on the homes, but then once they start reporting back to their companies and companies can figure out they can use this as a method of saving money, they're going to learn that they can't actually move to Ohio and save money based just on that. And they can't just move to Tahoe and save money based on that. So it's interesting that a company can do that, but of course they can, because the labor markets are very competitive, and you can always find other employees that would be less expensive, I guess. Anyway, so we're trying to find this house, and we just can't. That they don't. Everyone was literally. I looked at 20, and every one of them was pending. And if you look back 2 months ago, there was 20 there that were for sale that were not pending, and now they're all pending.
Mm.
Do you want to say something, John?
Yeah, interestingly, Sherry, my wife, the real estate agent, was talking to a client about a week ago, and he wants a second home, but he's not sure where he wants it to be. You know, should it be Tahoe? Should it be Palm Springs? Should it be this? So he's got this like 800-mile radius of where he's thinking about. So he asked Sherry if is there a company that helps people like him figure out where he would fit in, where would be a good place for him to buy a second home around here. And so she put it to her office. There's like 100 agents there, and everyone said, that sounds like a really great idea for a company, but we don't know of anyone that's doing that. So, his best bet is to try and figure out, 3 or 4 places where he thinks he wants to, and then reach out to agents in that area, because as far as they know, there isn't any kind of service like that. Back in the day, there's timeshares and this and that, but he's not interested in that. He wants to own his own place. So,
yeah.
Anyway.
I did have 2 other quick pieces of data that have come out. These are the big ones that came out in the last couple of weeks. The first is we did have the GDP number, and as expected, the GDP number of last quarter was horrendously bad. And I just want to talk about, so that's already known. I want to talk about how that's calculated. It's calculated on a quarter-over-quarter basis and then annualized. And so that's one of the reasons it was so bad. It was actually like a 9% negative quarter relative to the prior quarter, right? And you multiply that times 4, and that's how you get the 30+% negative GDP print. Now let's look at next quarter. Now next quarter, it's going to be compared to this last quarter, right? And this last quarter was the worst GDP print we've ever seen. So the bar is set very, very, very low, and we're going to clear the bar. And we're going to have a growth rate next quarter, and it's going to be big, possibly the biggest one we've ever seen. And at the end of the day, it doesn't matter. It's going to, in 1 year, you're going to have one negative quarter, another really negative quarter. That's Q1, Q2, then Q3, Q4. We're going to have positive. It's going to be a really big positive in Q3, and then you're going to have a higher hurdle. So Q4 is going to be a little bit less positive. Still going to be positive. And again, we're basically wiping away 2020. We expect it to be bad for the year. 2021, we expect to largely be in recovery. Now, what does that recovery mean? And that's the second thing that came out in July, this last week for July, and that was the unemployment number. Now, unemployment was 14.5%, which is an enormous number of people unemployed in April, dropped to 12%, 11.2, I think, maybe 11.4% in June. It came in at 10.2%. So that's a big improvement. And we talked about this at our halftime report. I want to mention it again. The likelihood of unemployment recovering to the 4% level in 2021 or even 2022 is very, very low. This will be the last thing that fully recovers. It will not fully recover until everything else is doing really, really, really well. And that is normal. So we can't look at unemployment numbers as an indicator of what's coming. Unemployment numbers are an indicator of what has been. So as the economy gets better and better and better, we are going to see those numbers improve. Now, not guessing what the next issue post COVID-19 will be. I have no idea what we're going to worry about next. There's going to be something. And so that anything that comes after this will slow that unemployment improvement. But as we were talking about, the first set of stimulus that came out, there was $3 trillion. We're going to see trillion and a half more, at least in the early period of COVID being there. That was plenty to fill the enormous gap. Now we need something to allow those folks who cannot go back to work, basically protect their families. That being said, people are choosing to eat in restaurants, not inside, but outside. Not inside here, but there are places in the country where they're eating inside. People are choosing to fly. Back in April, there was less than 100,000 people were flying in a week. Now it's 900,000 people. All clear will be 2.5 million, but we're not there. We're a third of the way there, roughly, a third of the way there, and we're improving across the board. People are choosing to go back to work because they need to go back to work, because they want to go back to work, and there's some people that can't. So when you think about the next stimulus that they're arguing about right now, it's going to be smaller for sure, and fewer people are going to need it or want it, and it's going to be there for people that can't go back to work, and hopefully those people all have access to it. It won't be the case. So there's going to still be a lot of need for us to actually give within our communities to help those that, food banks and those kinds of places definitely have to support those. So today, consumption, it's a strange, and this I think will probably lead to the next big issue. Consumption is becoming greater than production. And this is kind of what happens when stimulus happens. And this is kind of what happens, what that's a prelude to. It's a potential prelude to a more inflationary environment. I think this is going to be the argument that we have for the next 6 months to 10 years. How does all this stimulus play out over a long period of time relative to the value of the dollar? And because we have seen the dollar's relative decrease in value relative to other currencies, other global currencies. So I think looking forward, we're expecting a much larger Q3 growth number. We're expecting unemployment to continue to come down slowly but surely. We're expecting people to choose to go back to work and choose to shop more and choose to partake in services more. Right now, we're choosing to cut our hair at home still. My daughter's upstairs cutting Eli's hair as we speak. We'll see how that turns out in terms of a family argument at dinner. But I want to open it up for Scott to say anything, John to say anything, David to say anything as a discussion point. We're also going to talk a lot about more, probably not right now, but in the future, we're going to start really paying attention to the presidential election and what the news headlines more than anything, but what that portends for markets and economies going forward. But John, Scott, David, do you want to add anything else?
I think we had this conversation again, Paul and I, with this particular client last week, and she was asking all the right questions for someone who's concerned and worried, and the headlines. It was a really good, back and forth about all these things that had her uncomfortable. And we showed her lots of charts and things and talked through a lot of the concerns. But I think another point is really important that we really hit a finer point on, and that is that we're global investors. And that as much as we have a problem here in the United States, this pandemic, there are a lot of countries that have no problems at all, or mild problems, that are thriving. And so with that being said, I used to do these investment dinners, 10, 15 years ago. And I remember vividly, I'd ask a group of people, lots of educated people in the room back in the day. And I would say, okay, so everyone loves the United States. We love our real estate. We think our markets are the greatest in the world. How many times in the last 20 years, and I'll ask anyone on the call today if they know this, how many times in the last 20 years do you think the United States has been the #1 performing country out of all the developed countries? You're talking France, Germany, Japan, Norway, all the developed countries. There's 20 of them. We're going back 2 decades. And the long-winded answer to the question is, the United States has only been the #1 performing country on earth once in the last 20 years. So what does that mean? Well, it means that there's a lot of other countries doing really, really well too. In a lot of cases, doing better than us. My favorite example of this is actually that country up north. Prior to Justin Trudeau being handsome and all over the news, everyone knows who's running that country. Getting back to what I used to ask 10, 15 years ago, I'd ask a room of 15, 20 people every single one of these investment dinners in the 2000 to 2005 range, who's the fearless leader up there? Is it a prime minister? Is it a king? Is it a queen? Is it a jack? Who's running that place? And I kid you not, nobody knew. And I mean, nobody knew, ever. The only person that finally showed up and knew was a Canadian, a former Canadian, that was it. The point is, we believe that, we're the only game in town, and the United States is where it's at. And there's some validity to that to some extent. But again, just to crunch some numbers, after the tech bubble happened, 5 years took place: 2003, 4, 5, 6, and 7. We came at a horrible bottom, went to all-time new highs before 2008. Here's the punchline: every single year, with no exception, Canada outperformed the United States. When it was all over, 150% to 60%. Wasn't even close. Over two times as good as we do. The point is, there is a wealth of opportunity out there in the globe, and that's why we at Mindful Money invest on a global basis. So important and critical that when other countries are hurting, maybe like we think we are, there's a lot of countries that are thriving and always do. I really want to hit that point.
I just love the fact that you slipped in Mindful Money there. That's awesome. Thanks, Scott. Yeah, David?
Well, I was only going to make the point that the largest companies in the S&P also derive 50% of their income outside the United States. So that even within that context, you're getting some diversification.
That's fair.
Great. Thanks, David. And we have, as the last few times we've done this, it's kind of turned out this way. I think maybe we've answered everyone's questions just in the conversation. If somebody has a question and they're not asking it, don't hesitate to send us an email. Happy to answer it that way. I think that covers our comments for the day, and I'm happy to take another question if there's anything out there. If not, I just want to say thanks for coming, and we'll do this again in a couple weeks, and we'll keep doing this. I'm guessing, we had this question earlier, whether or not we would keep doing this or make it a little bit less frequent. But I think that through the election, I think it makes sense for us to keep doing this through. We'll have a lot to talk about. There's still a lot of unknowns, and I think we're going to keep doing this. I think there's enough people that have some curiosity about it that we'll make sure we keep sharing what we are seeing and thinking. Just keep our transparency up as high as we can. So thanks everyone for coming, and we will see you in a couple weeks. If we don't see you this Friday at Kitchen on Fire.
Correct.
All right. See you, everybody.
Thank you. Stay safe. Wear your masks.